All right, guys, in this video, what we want to talk about is really the first step to becoming a homeowner outside of figuring out the why and figuring out how to build that motivation, and that is the pre-approval process. Now, the pre-approval process, I think this is where people get overwhelmed because they think, oh, I have to know so much information. You really don't. It comes down to 4 key components: credit, assets, income, and debt. Well, DTI, which is your income minus your expenses. Now, Neil, one of the things you and I found out early on, or that I learned, one of the biggest reasons why people don't qualify to buy a house is what?
Because they don't have good credit.
Credit is your ticket into the game, boys and girls. I cannot stress enough how important it is. Neil and I were starting to calculate about 40% of people get denied for a house purely because of credit. And what are the biggest reasons that you see people have bad credit for?
Because here's the thing, they pay their bills, but they pay them late. I see it all the time, a credit card where they paid it 5 days late. Well, you're going to lose 50, 100 points. People think it's not a big deal. Oh, I didn't pay my car last month. Well, guess what? It is a big deal. Nobody's giving you a mortgage if you can't pay your credit cards or car payments on time.
And one of the other things that we see, and we've seen this, is people, they may have like a $300 or $400 credit card limit, and they don't think anything about letting that credit card max out
at $400.
And then they just pay the minimum. We had a simple case of a guy who had his credit score would have gone up 100 points. He had like a 540 credit score. His credit score would go up 100 points if he paid off his credit card to $5. His balance was $418 on a $300 credit card. So he was over 100% utilization on that credit card. If he just paid it down to $5, his credit score would jump 100 points in a matter of 30 or 45 days. So that's just really how important credit is. Next, we're going to talk about assets. Assets are money in the bank. Now, Neil, what kind of bank accounts qualify as money in the bank?
401k. You can also have a gift. You can get it all a gift from a relative as long as we can prove that they have the ability to give it to you. It doesn't have to be your assets. You can get it from a mother, brother, father, sister, significant other. I mean, it doesn't really matter. But like I said, a 401k, a savings plan, a checking account. What else?
A regular savings account. You're checking your savings, a deferred comp plan.
Yeah, if you work for the city of Philadelphia, you have deferred comp.
Yeah, if you're a teacher, there's 403Bs and stuff like that. Guys, anything that is traceable by money. Now, mattress money and money under your pillow does not count. It has to be something that can be shown or proven that's been in an account for at least the last two months.
Yeah.
60 days, it's what's called seasoned money. The next is going to be income. You have to show 2 years of work history. Now, can you have multiple jobs?
You can have 10 different jobs. Yeah, you're going to make.
We hope you don't.
Right, we're going to make our job harder because we have to verify them all. But if you have 2 years of income and you just left one job and you think you can't get approved, we don't care. If you left a job to take on to make more money, even if you're making less, if you qualify, you qualify. We just need 2 years of income.
So it's really important, guys, if you have not had 2 years of income, where you have 2 years of W-2s, even if, again, maybe let's say 2 years ago or a year and a half ago, you had 2 different jobs, and now you have 1 job, but as long as you've had 2 full years of work history, that's fine. Now, you cannot use both jobs unless you've had 2 jobs for the last 2 years. That's the only way you can use the income from both of those jobs. But let's just say you started a second job 6 months ago. Even though we cannot use that income, you still can use the money you've generated from it to apply towards your down payment or your closing costs, but we can only use the 1 job if you've only been at 2 jobs for 6 months.
Right.
So the last thing is going to be the debt to income, and we're going to talk about this. Basically, it's calculating what is your total income minus the expenses that show up on your credit report. Things like rent and things like your car insurance do not count, but things like your credit card or personal loans or auto loans, that stuff that is going to count towards your debt to income ratio. We're going to dive into all that stuff in the next video, so we'll see you in the next video in a second, guys. Thanks.
Awesome.